Kind Profits here with another video. Today I'm going to talk about the price to earnings ratio, which is a good method for comparing stocks. It's an important thing to keep in mind in that stocks are traded to different levels compared to how much money they're actually bringing in. So let's say a company brings in $100 million in earnings a quarter and they get traded at a 16 to 1 price to earnings ratio. That means that the market cap of the company is 16 times the earnings, so it would be about 1.6 billion. The S&P 500 tends to oscillate, I believe, between like 14 and 17 price to earning ratio on average, but it varies a lot from sector to sector. The companies that have the highest price to earning ratios tend to be tech companies. They might be traded at maybe even a 30 price to earnings ratio. You'll also see that price to earnings ratio could suddenly go up a lot. For instance, let's say there was a bad quarter, the earnings were low because of various expenses, lower than what they normally are. So maybe normally it's 100 million, but for things happened that quarter that lowered them all the way to 50, but the price for the stock didn't go down very much because people knew it was a temporary issue. Then the price to earnings ratio could double. So if suddenly you're trading a 32x in the above scenario because the price didn't go down, people understood what was happening. It was due to external factors that they don't blame the company on. It didn't dim their long-term outlook for the company. But keeping this in mind, what you have to realize about price to earnings is why would you trade at different ratios? The basic idea is the time value of money, that today's stock price should have in some way reflect the amount of money that the company is going to generate in the future. But money generated in the future is less valuable than money that you already have today. You can understand that just by interest, that let's say that you are going to get $1.6 billion over the next 4 years. It's better to have that $1.6 billion today than having it broken out into once a quarter increments. So, because if you did have it today, you could invest it and it would go up in value. And you would be able to get more than $1.6 billion if you invested it today. 4 years from now, it might be $2 billion. But if it's only coming to you spread out, it's going to be less than that. So you have to discount it. The other aspect is the interest rate, that in 4 years, a dollar won't be able to buy as much as you could buy today. Typically, because of interest, things go up in price. So you might be able to buy a pound of sugar today for $1, and in 4 years only be able to buy 0.9 pounds worth of sugar for $1. You would have to pay $1.10 or something to get a pound of sugar. So these are some things to keep in mind. You just make sure that you're making intelligent decisions with price to earnings ratios. One of the reasons that tech companies get traded at a higher price to earnings ratio is they're building into the assumption that earnings are going to go up over time, that you're only making $100 million today, but your technological innovations are going to cause your earnings to continue to rise. So you're making $100 million now, in 2 years you'll be making $150 million a quarter, in 5 years you're making $200 million a quarter. And so therefore, even though you're only making $100 million a quarter now, the expectation is that you're going to beat inflation and beat the rest of the market and how fast your earnings go up in the future because of new products and such, and therefore you can trade at a higher price to earnings ratio based on what your earnings are today. More stable companies, like someone like a Procter & Gamble that just sells consumer goods that are fairly stable, might get traded at a lower price to earnings ratio because people aren't going to pay that much more for soap or whatever simple staple goods that the company sells. But it is a way to compare things inside of a like sector. So if Lyft is getting traded at, these are two companies that haven't been listed yet, but are planning to IPO this year. If you're looking at Lyft and Uber, and one of them is getting traded at 30x price to earnings ratio, and one's getting traded at 20x, but you really think they're about equally valued, or you think they're really going to be about earning the same earnings in the future, then the one that has the lower price earnings ratio might be the better value selection, that you're buying it because it's undervalued compared to the other one. Or you might just, even if not buying one, you might choose not to buy the other because you think the price to earnings ratio is too high. You don't believe it's actually going to meet the earnings growth in the future that have already been built into today's price. So always within biotech, within technology, within an industry itself, look at the price to earnings ratio when choosing between companies, in addition to looking at things like ESG and other factors that you think are important. But it's a good comparative way to judge companies. Thanks for watching. Kind Profits out.